Okay. All right. Well, good afternoon, and thank you for joining the webinar today. Most importantly, we hope that you, your loved ones, and your employees are staying safe and healthy. My name is Greg Hobson, and I'm a partner and co-practice lead for the institutional consulting group at Greenspring Advisors, where we work with mostly defined contribution 401k, 403b plans, but also some pensions and so forth. Today, I'm joined by Ryan John, CFO of Independent Can Company based in Belcamp, Maryland, and Mike Boer, the Director of Assurance and Advisory Services Practice at Clearview Group. So unlike most webinars you've probably sat through over the past 12 months, our format's not going to be death by PowerPoint. Mike and I each have one slide, and Ryan doesn't have any slides. We're going to make this very conversational in nature so that we can hopefully answer a lot of the questions that you have. We had a number of questions submitted upon registration that we'll get through. So before we get into the short part of our presentation, followed by a lot of that discussion, I'm going to go through review the format and the technology information. So we have a number of people that are on the webinar already and more to join, hopefully. So everybody's line is muted. We've got a lot of great information to cover, including a number of questions, as I said, that were submitted upon registration. And we'll be taking questions from you. So if you have a question during the presentation or during the Q&A that we're going to run through, feel free to go in the Q&A section and submit that question. As the moderator, I'll be trying to navigate through that and make sure that we can get to every question that we happen to have, which you'll find that Q&A section in the Zoom toolbar. So now to sort of the presentation part of this. Plan audits. I mean, what can I say other than it's, required once you reach a certain number of employees, generally 100, 120, you kind of look at as you go over that number. But, outside of that, a lot of people consider it as just a requirement, a pain. It's a challenge to get through. It's an additional cost associated, for our firm. However, I would argue that while it's a necessary evil, a good auditor can truly help you find any operational inefficiencies or issues that you happen to have with your plan to ensure that your participants are getting exactly what they signed up for. And that, on top of the fact that ensuring your participants are getting what they signed up for, it can be incredibly helpful that if you have a really good auditor going through that on an annual basis, that if the DOL or the IRS actually come knocking one year, that they hopefully won't find any issues if you've got a good auditor in place. And that's really one of why it's important to treat the annual exercise of the audit the same way that you do all of your other important employee benefits programs. So I'm going to kind of go through one of the things that we look at from an advisor perspective. It really comes down to when you think about setting yourself up for an audit and what you're going through is really establishing a very good or great fiduciary governance process. And when we go in as an advisor to a lot of plans, what we find is that, they may have some of these things taken care of that you can see on the screen. But in a lot of cases, they don't have the formal documentation to go along with that. So, the steps that we look at to ensure that, at least on the advisory side of the business, that you're doing exactly what you need to do to get somebody that is a retirement plan specialist and not a personal financial planner that maybe has 2 or 3 401k plans or 403b plans as part of their practice, but really hiring someone that specializes in this. And in those cases, you're generally going to be hiring a fiduciary advisor to your plan who can really help you with the formalization of your committee, providing the appropriate documents for committee oversight so that everybody that sits on that committee understands that they are a fiduciary to the retirement plan and that they have a legal responsibility to act in the best interest of those participants. And, providing that training, from a specialist type of firm to ensure that everybody that's sitting on that committee truly understands what those responsibilities are. We see a lot of plans, while an IPS or an investment policy statement is not a required document, it's almost worse to actually have one and not follow it, right? So we want to make sure that when you structure your committee and you structure your setup so that the investment policy statement is aligned with the reporting capabilities that you have, that you can actually check the boxes of, hey, this fund's meeting the criteria, this fund is not meeting the criteria, and that you're conducting, at least annual. We do it more frequently for 99% of our clients, semi-annual type of review meetings, and that those meetings, and this is probably the most important part of what I'm going to say here, and that's documenting those meetings with formal and decisions around plan design and investments and vendor selection, all documented, so that if you ever are audited, from the big audit, DOL or IRS, that you can justify the decisions that you've made along the way, and you can document those decisions. Because we all know we're not always going to make the right decision as it relates to an investment or something along those lines. But documenting why you made the decision is what we feel the most important part, really, of what you're doing, from a committee perspective. And then those meeting minutes, you can then share, and generally your auditor, the auditors doing the annual audit, like Mike and his team at Clearview, are going to ask for those meeting minutes as part of the process that they go through. As we all know, fees are the hottest topic in terms of litigation in the retirement plan marketplace. We certainly believe that, at least an annual benchmark of your fees, and that's not just your total fees. That's looking at, the fees in sort of the three breakdowns of what you have: your investment costs, your advisory costs, and your record keeping costs. So document and benchmark those fees and determine the appropriate way as to how you're going to allocate those costs. Are those going to be paid 100% by the participants? Are they going to be paid some by the participants, some by the plan? Are they going to be paid on a pro rata basis or a per head type basis? So there are a lot of decisions that you need to have and formalize throughout that process when you think about a good fiduciary process, when you think about, how an audit could come upon you. We recommend using a fiduciary file. We have what's called our fiduciary dashboard, but others, just one place that you can find all of those documents. And then hiring an experienced employee benefit plan auditor. One of the things that the DOL came out with a few years ago is really to ensure that plan sponsors weren't hiring, similar to how we say use a retirement specialist advisory firm, that you actually use an accounting firm or an audit firm that does this with great frequency, so that they truly understand the process associated with what a 401k, 403b retirement plan audit actually entails, and that it's not just something they do to keep their staff busy in the summertime, right? That it's an actual legitimate part of their practice, that the individuals that are working on those audits are trained specifically around employee benefits. They're getting this training each and every year to ensure that they're up to speed with that. So, from an advisor perspective, again, there's a lot of information here, but it's truly about just establishing the right process. And getting a firm like a retirement specialist firm like Greenspring, you can do that. And there are a lot out in the marketplace, but that's where we say hiring a specialist firm is really the number one part of getting the rest of these things aligned, so that you can sort of not have to worry about it and ensure that whoever you've brought on board is going to do a good job to help you navigate this benefit for your employees. Now, we always have to throw the disclosures up because that's what the SEC tells us. So I'll put that page up there for you. But now that I've hopefully laid out some of the items to ensure you have a good foundation around the fiduciary process as you enter your audit season, I'm going to really turn it over to the folks that have a lot more experience with the actual nuts and bolts of an audit. So first, I'm going to turn it over to Ryan John, CFO of Independent Can Company. Ryan began his career at C.W. Amos, for those of you that remember that accounting firm that was around here. and then spent basically nearly 20 years at Albin Cat. And then he moved about 2 years ago to Independent Can Company in July of 2019. And he is a leader with a proven track record of directing finance, sales, technologies, and operations. So he's got a wealth of experience, not just in the finance, but also operational and other parts of businesses. So I'm going to turn it over to Ryan, and it's all yours.
Greg, thanks. And that's too kind, that introduction, but I appreciate it. So as Greg said, I'm the CFO of Independent Can Company. We're a 91-year-old manufacturer of metal packaging based in Belcamp, Maryland. We've got 6 locations across the country in 4 different states. And we have right now about 375 employees. It's a fun business, and it's one that we're proud to be long-term members of the Baltimore community. When Greg asked me to do this, I'd stopped and thought, this is not one of the things that's on my to-do list every day to think about how we handle our plan audit, but it is awfully important. While you may not think there's a huge upside to effectively managing your qualified plan from a technical and fiduciary perspective, the downside of not doing so, in my opinion, is gigantic. The technical nature of this work is such that few of us in roles like mine have the knowledge and background to effectively run a plan without outside help. I've learned over the years and developed a philosophy that around qualified plans that I like to think of as a 3-legged stool. The first leg, in my opinion, is the right plan advisor or consultant. And not long after I arrived at Independent Can, we brought on Greenspring and Greg in late 2019. The next leg of that stool, in my opinion, is the right plan record keeper. And we did, with Greenspring's help, evaluate a number of different record keepers, and we did make a switch in the middle of 2020 to Empower. And again, grateful for Greenspring's help in making some of those decisions and looking at a lot of really qualified record keepers to consider. And then the third, which is what we're talking about today, is the right plan auditor. And we did make the decision to switch auditors for our 2020 plan audit, and we are moving to Clearview. So again, from my perspective, doing what I've done for nearly a little over 20 years, actually, the right group of experienced external partners, the areas of risk and challenge around things like CARES Act, other legislative changes, we know those things are coming fast and furious. Proper documentation, how do you document errors? We know they happen, we're all human. How do we document the corrections that we need to make for those errors? And any advice on where the qualified plan can be a recruiting tool in a tight labor market are all things that the right 3-legged stool of support can help you be successful at. So there's a couple minutes of my perspective on things, and now I will pass it over to Mike.
Thanks, Ryan. And I'm privileged to lead the Assurance Advisory Group at Clearview Group. We're probably the biggest, most experienced firm you never heard of. And hopefully you're starting to hear about us. We're 10 years old. And when we started, our founder had, he likes to say, no clients, no computer, no money, and a cell phone. And 10 years later, here we are, over 100 people serving just about every aspect of the market you can think of. And when I joined, I said, folks, the employee benefit plan audit space is vastly underserved. And to Greg's earlier point, you have a lot of firms out there that either treat it as a one-off, just catch as catch can, or it's just summer filler work. And we felt like that it really needed to be served well. So that's what we've done. We've built, I think, a model practice that's doing a lot of things. So, in terms of just some of the updates around what's going on, I'm going to be brief. In terms of regulatory, I can't think of anything more boring than talking about employee benefit regulatory updates, other than to say there's a few. I would ask your auditors about this kind of thing. There's a few updates around some of the fair value disclosures you'll want. Most of that doesn't really impact most benefit plans. Your opinion is going to look a little different next year, but it's really wording. It's going to say the same thing, just with some different words. So the regulators, or I guess the standard setters, have been a bit lenient, or they've given us a chance to catch up on some of the changes they made over the last 3 to 4 years. But the CARES Act came along this year. And the impact of that, really what happened was Congress allowed more, there were looser requirements or regulations around some of the distributions, the hardship withdrawals, things like that. Your record keeper, your trustee should be able to help you through that. And then the Stimulus Act, which was signed in December by President Trump, that really extended a lot of those waivers and benefits and withdrawal, loosening of the rules around them. So you're going to see probably a lot more withdrawals, a lot more hardship claims, that kind of thing. There were some requirements around it needed to be related to COVID, and some of that was up to interpretation. But I think generally, if you can claim it was COVID related, you're going to get that distribution. Now, some of the misconceptions that plan sponsors have, I'll tell you, this not really, when you get into a benefit plan audit, it's not so much a financial statement audit, it's more of an operational audit. It's more about, is the plan operating appropriately? Because in the end, the DOL cares more about, anybody can look up an investment valuation on the internet and see that it's valued properly, because there's an active market for these mutual funds and whatever you're investing in, any investment vehicle. DOL just cares that the employees are taken care of. That's what they want. As long as the employees are taken care of, they're being credited appropriately, that's what they want. The other thing, you may think that your audit firm is being picky, and honestly, we are, because it's that old Elvis Costello song, or that movie, Who's Watching the Detectives? Well, auditors are being scrutinized. I sit on a regional and a national peer review committee, and we're being scrutinized. And guess what? If your audit firm audits benefit plans, those are must selects. The peer reviewer must look at a sampling of benefit plan audits. And I can't tell you how many times we get to the report acceptance board level on a national level, and benefit plans come up. There's a lot of issues around those. So just know your auditors are under pressure. You may think it's a non-event, but it really is. It's a big deal. And just some high-level tips as we go into busy season around the filings. Greg talked about that fiduciary file that Greenspring or most of your advisors will have. Take advantage of that. Make sure all your documents are in order. When you do get your service auditor or your service control reports, the SOC 1 reports, if you will, make sure you document your controls around that, making sure that you don't have garbage in, garbage out. Probably the biggest thing we could say, though, is assign a point person and organize and communicate early. Because what we see happens is you get through the winter, you get your commercial audit done, your sponsor audit done, take a break, say, hey, we need to get on the benefit plan. Oh, now we're in vacation season. We go to the beach, and we come back after Labor Day, and we say, we have 6 weeks to get this done. So the earlier you can communicate, the better, because you're coordinating across multiple parties. Not only the management, you have your trustee, your advisor, your auditor, a lot of things to coordinate. So early and often, and then hopefully by Labor Day, you can put it to bed and move on.
Great. Thanks, Mike. I appreciate that. Some great tips when you sort of think about, what's coming up. I think that last one being probably the most important of getting it on the table and scheduled as early as possible. A lot of the record keepers that, we work with, some of the largest in the industry, have those reports pretty much ready to go. You can start this process now. In a lot of cases. Now your 5,500 might not be 100% ready, but you can at least start the process of looking at it and scheduling it for June, July to get everything done. And as we were sort of commenting before the webinar started, with the continuation of the pandemic and a lot of companies, they not open for their own employees, or if they are, it's in a limited scale.
Right.
That they're not really letting outside parties in. So it's maybe not an on-site audit again in 2021 for the 2020 plan year, similar to what what you guys experienced last summer. But at least scheduling it, keeping in touch with your auditor to ensure that they know exactly when it's going to, when you're sort of planning on dealing with this and navigating through that process. So appreciate that information. So from a Q&A perspective, we actually had a number of people submit questions upon registration. So we're going to go through those. But again, would remind any of the attendees, if you go to the Zoom toolbar and you go to Q&A, you can sort of enter your question there. I will try to get to it. But I wanted to start with a question for Ryan John. So this came from obviously somebody that you knew somehow, because they asked, so you had changed auditors this year, as you mentioned in the presentation. Sort of what was the process that you went through in terms of, and ultimately you selected Clearview, but what was the process that you went through to select a qualified 401k auditor in your opinion and evaluation, Ryan?
Yeah, it's a great question. We undertook a process to change all of our accounting support work throughout the company. So this was part of it. And so we were looking very clearly at a couple of things. One, obviously, from a fee perspective and the fiduciary side of that. But also, probably more importantly, you need to balance then the technical capability. So it goes back to what Mike was talking about. We wanted to make sure we didn't have a firm that was just filling, slow season with a few benefit plan audits. So part of our process was very much to understand the number of plan audits that our potential auditors were doing. Do they have someone dedicated to that person on their staff, or to that work on their staff? What's their background? Have they been doing it for more than a couple of years? So those are the types of things that we looked at, and when it was all said and done, Clearview was the right choice. So.
Great. And I know that was a pretty extensive and thoughtful process that you guys went through, similar to how you guys went through the process of, when we helped you with the record keeping side of things, and looking at, the top tier record keepers in the marketplace, and whether or not you should, head leave the one that you were currently under. So I'm sure a similar process, if it was anything like that part.
It was three plus, folks we were looking at. So we had multiple folks that we talked to, and yeah, it took us a couple months to get through that.
And I want to compliment Ryan, because I've known Ryan for a while, but we didn't get home court advantage. I mean, it was thorough, and they scrutinized us. So it wasn't as if, oh yeah, I know Mike and the team, you're hired. Yeah, it was competitive.
Well, and Mike, just, as you sort of look at, maybe a little bit more of the technical side, one of the things you mentioned during the presentation that the DOL, these audits are not so much around the financials, right? Because, just the way the record keepers, have their system set up, that, these are limited scopes audits in most cases that you guys are doing, for, clients of ours and others. But when the DOL is coming in, they're focusing on operational issues, right? It's we see delinquent payroll deposits. So for example, a company sets up and they start, they're regularly sending employee deferrals in, 5 days after the payroll, right? Or the pay date. And then all of a sudden somebody goes on vacation and is like, well, I can, and they get it done in a day, right? And now that's your new standard. So, delinquent payroll deposits, or changes in those, and then lost participants seem to be some of the really hot topics that, when the DOL comes in, when you guys are doing this from an annual audit perspective, are you guys looking at the same things, or what are maybe some of the other areas that you're looking at beyond the payroll deposit timeliness and lost participants?
No, you've hit on a couple of major areas. We do look at that. The timely remittances is a huge one. And as you say, if you start submitting within a couple of days, that's kind of your new normal. I'm getting tired of that phrase, but under the ERISA standards, it says you have until the 15th of 15 days. That's not a safe harbor. You need to get it in as quickly as you can. And so to your point, if you've consistently been at 6 or 8 days, and then after a while you get down to 1 or 2. Guess what? 1 or 2 is your new standard. So because otherwise the DOL says, are you playing games with participant accounts? Same with these lost participants. You need to make every effort to find them. You can't just say, oh, they moved and their email is bouncing, so sorry, we get to absorb that back in. You can't do that. You need to be a little more diligent about it, hiring someone to go find them if you need to. So as I said earlier, it all gets back to the DOL cares. Are the participants taken care of? Are they protected? And to your point, it's really operational, more so than a financial statement audit. One other thing I thought about too is the DOL a few years ago, it's affectionately called the Dabbler Initiative, where they embarked on finding these audit firms that dabble in benefit plan audits and making sure they knew what they were doing. The thinking being, and rightfully so, if you do 1 or 2 a year, you're probably not very good. And not to say you aren't, but there's a presumption that you really don't keep up with things. So that has kind of run its course a bit, but still you see the DOL going in and saying, how many benefit plans do you do? If you're doing 10 to 15 to 20, okay, the peer review process is going to take care of you. If you're doing a handful, you're probably not very good. Are you in the audit quality center with the AICPA? Things like that.
Great. So kind of moving on to the next questions, or really 2 questions. And it's sort of the same question asked about 2 different advisors. So for example, the first question that came in was, what are the obligations of the financial advisor, financial advisory firm, and record keeper for a plan audit? And the second part of that is, if there was another financial advisor firm or record keeper at the beginning of the plan year, and then it switched, to what extent are they obligated, by law to participate in the audit? So I'm not an attorney, so I'm not going to answer the part by law. My compliance staff would be very upset if I were to provide any sort of legal opinions around that. But I think there's 2 components there, right? The financial advisor and the record keeper. So from the financial advisor perspective, again, I think legally, there's, most of the contracts that advisory firms have set up are not going to include, sort of participating in the audit. But any advisory firm that you work with or hire, I think what you want to ask about is, are they going to, help you with your annual audits and providing the documentation that's needed or requested by the auditor? And that also goes to DOL and IRS audit. So are they providing quarterly reports on the investment performance that tie to the investment policy statement? All the stuff that we talked about, or that I mentioned at the very beginning of the presentation, as well as the meeting minutes, right? That to document that process. And it's from a legal perspective, none of that stuff is necessarily, you don't have to have an IPS, you don't have to have quarterly meetings, but as written out by law, but you do need to have, fiduciary oversight. So that's a very broad definition of what you need to do, but hiring a retirement plan specialist type of firm is probably the best way to do that, because that firm, it's in their best interest, because they're signing on as a fiduciary to ensure that you get through the audit process regularly, or in an easy, meaningful way. The record keeper, there is a little bit of a difference, right? Because a lot of those contracts that you have, the service agreements that we see and review for our clients, they do have, requirements, or as part of their service agreement, what they're going to do. So some firms actually, or some record keepers actually have specific audit groups. They have audit packages that are available, well in advance, or right after, the end of the year around this time, where you can get those audit packages to be able to deliver to, electronically to your audit firm. They're going to have provide access so that you can set up a user, just like you have your advisor or any of your other staff that have access. They're going to be able to provide that access so the auditor can go in and do the required testing that they need on, looking at, X number of transactions, X number of distributions, to ensure So, from that perspective, I think that's what you're looking at. And it's not really a by law, it's more by the service agreement or the contract that you have with that organization. So that's really the part that you would want to look at. And as you're hiring, sort of, what is that, what are those firms committed to help you through the annual audit process? And then if there were ever, a full-blown DOL or IRS audit. I can tell you from an example, I've had a number of clients that were audited, one IRS and a few on the DOL side. And it's actually incredible to me that in some cases, this was probably 6 or 7 years ago, I had a plan that was audited, and the IRS auditor literally had no idea what revenue sharing was in a retirement plan, which was mind-boggling to me, that I was the one explaining all of this stuff to an auditor that is supposed to be evaluating, this plan. So it was a little bit confusing and nerve-wracking at the same time. But we've had other cases where, that we've used that fiduciary file where, we've had a conference call with the record keeper, the regular plan auditor, and the client, and basically said, okay, we're going to consolidate. These are all the documents that the DOL is looking for, because they'll send you that document request list, figure out what's there, who's going to upload it, share it into one server so that it's easily accessible, so you can bundle it up, send it on to your auditor. And we actually had a DOL auditor say to one of our clients, like, this was the most organized audit we've ever gone through in their experience, because if you get all of the parties working together, that's a great way to go about it. Right? It's not just, oh, so who's going to do this and that. It's how you combine it to pull that together. So that's a really good thing. The next question from the same person, sort of continuing on this path, and Mike and Ryan, I kind of maybe ask you guys this too. I'm happy to chime in, but when would an audit, and this I would assume would be more DOL or IRS, warrant an ERISA attorney involvement? So I have my opinion on this, but I'd love to hear what you guys have to say.
I'll go first. From my perspective, anyone would, period.
Mike?
Yeah, I think that's right. I think eventually your plan's going to need that ERISA attorney. They are very specialized. They are very focused on the nuances of the law. And I kind of boil it down to, you need to consult with them when you set up, when you change up, when you do a checkup, or when you screw up. And a lot of the screw ups, a lot of the operational failures, you can correct yourself, but it's usually a good idea to get that ERISA attorney, at least their perspective on it. The more severe, the more involvement they're going to have. But anytime you do a change, a setup, there's a mistake, I'd call.
And I think as it relates to an audit, I would say, Brian, to your point of like, as soon as that happens, I would say you probably, there's a point during that process that you might want to, employ the services of an ERISA attorney. Because if you have everything buttoned up pretty good and you send it off to the DOL or the IRS, like we kind of talk about that package, and they come back with not a whole lot or nothing at all, then you don't really need to worry about it. But if they come back and say, or start questioning some things, then it's probably a good idea to pull your auditor in, or your attorney in. Or in some cases, it depends on your record keeper. So, I have a public company client that I work with, and they had a DOL audit probably 3 years ago. And they actually paid, this was not your sort of typical insurance mutual fund company record keeper, a little bit more specialized. And they literally paid the record keeper consultant to sit in their office with the DOL auditor for 3 days. And it was a much less expensive cost than having an ERISA attorney in there, but they had a lot of changeover in their benefits department. So a lot of the questions they're auditing 2 years ago, right? And that person wasn't in place that was really handling it. So they really just sort of had this intermediary because that record keeper had been in place and the consultant had been in place to kind of help with it. So, I think there are times you definitely want to get involved if you really find that you have some critical errors, or as Mike says, screw ups. You definitely want to do that, but you might be able to get away with it depending upon how buttoned up your process was to begin with. Mike, I always get this question every year, and I just feel like it's always a good thing for people to hear, is because it goes on the 5,500. What's the difference between fidelity bonds and fiduciary insurance? I'm sure you get that question all the time. We do too, but what do you kind of guide clients with?
Yeah, it's basic fundamental element. The bond is required, and it protects the plan. So that protects the assets of the plan from any kind of malfeasance or fraud, et cetera. Now, the insurance, that would protect the fiduciary. It is not required. And by fiduciary, I mean the person who's actually handling somebody who works for the plan sponsor, actually handling the plan. That's optional. I think it's a good idea. And it protects you against those basic, maybe just human error, just honest mistakes. It doesn't insure you for fraud. That's for sure. It's not the old Steve Martin line. I forgot armed robbery was illegal. It only protects you against honest mistakes. So that's the difference. The bond's required. It protects the plan. Insurance is a really good idea, and that's really more toward the fiduciary.
Yeah, and that's a really good explanation of beyond the fact that it's required. It's sort of who it's protecting, right? It's
right.
Protecting the plan versus the plan sponsor and the fiduciaries and the employees that are
that's
working
right.
on the plan. And I would tell you that if you we always get this sort of deer in the headlights look when we say, when we're first brought on board, we always mention, fiduciary insurance, and everybody says, yeah, we have a fidelity bond. And we're like, no, that's not what we're talking about. It's a totally different thing. But then like, yeah, but that's probably in our D&O insurance. And it's not, right?
Nope.
It might be part of it, but it's generally, a separate, policy or a separate component of that policy, specifically around fiduciary liability insurance. And it's becoming more and more popular. We think it's a great idea for plan sponsors to get that in place, because even though you might hire a fiduciary like a Greenspring, or you might even hire a record keeper that acts as a fiduciary, as a 316 record keeping or administrative fiduciary. There's always these sort of co-fiduciary responsibilities that, ultimately the plan sponsor is still going to get, if you get sued, you're going to get sued. So, it's a good idea to have. So,
right.
Last couple of questions. To both of you guys, what are the biggest deficiencies you find? Mike, more to you. What are the biggest deficiencies you find with plan sponsors? And then maybe to both of you, what are the biggest deficiencies you find with various record keepers and administrators?
Yeah, just a few. We've kind of talked about some of these, as the mistakes in processing the participant accounts, making sure that their eligible wages are factored in, the late remittances we talked about, mistakes in computing vesting, some of just basically the calculation errors. And what it usually comes back to is not following the plan document. We haven't talked about that very much, but the plan document is really the end all be all. That once that gets approved by the IRS, that is kind of your guide. That's your roadmap for administering the plan. So making sure you follow your plan document, that's the biggest thing. And then the other issue that I think permeates not just benefit plans, but business in general is cybersecurity. Let's be honest. You're dealing with people's retirement accounts, sensitive data. Cybersecurity is huge. And so making sure that not only are your advisors, your record keepers, your custodians, everybody maintaining their own security, but make sure you have your own cybersecurity and going back and forth, because the bad folks are out there and they're looking to pick that data off.
I agree with you 100%. I mean, that's, we're starting to see, there's fraud really prevalent in trying to access participant accounts for distribution purposes. There was a suit against Fidelity. The person ended up losing, but, there was actually a suit, this was 2020, I think. And we're starting to see more and more of that. I mean, there's huge dollars here, right? So when you think about the cybersecurity and the fraud side, anything from your end, Ryan, that you kind of think of when you in the prior audits that you've been through?
Yeah, I think Mike's spot on with what he's saying there. The cybersecurity piece is definitely on my mind currently. I think the DOL, in fact, just came out with some guidance here in the past week or so with regard to that. Every record keeper is going to have their nuance that maybe they're not as good at. I think it's just a matter of making sure you understand that, and then when things happen, document, right? Just document the way that something is corrected if there was an error made.
Right. Yeah, I agree with you 100%. So do you guys have any suggestions for specifically for plan sponsors in terms of buttoning up their internal processes to help ensure whether it's smooth data transition, and any tips that you guys have from that perspective? And then we actually have a question from somebody in the audience too. So
yeah, I can go ahead on that. I think two or three things come to mind. One is, again, back to what Mike was saying earlier about the timing of your contributions, right? Just make sure that you have a process in place. If you're on the plan, you're a plan fiduciary, but you don't have responsibility directly for payroll, for example, make sure you work with your HR department and that timing of contributions is spot on. Number two is just make sure you understand who's responsible for what, right? So when it comes to any amendments being made to the plan, any of those types of things, make sure that there's one kind of final point of review for that before a decision is made. And then the third I would say is just constantly be thinking about how you can make your plan better, right? So it's back to the three-legged stool, right? Always be making sure that you feel good about your fiduciary or your advisor that you're working with. Make sure that you feel like you're still competitive and benchmark the fees, both for the record keeper and for the auditor. That to me, there's two big things relative to the plan. One is very negative and one is very positive. The negative is we just don't want to screw this up. We want to take care of our employees. We want to make sure that everything's handled properly, and we don't want to have an audit that ends up poorly. But on the positive side, you want to have a plan that attracts employees, right? You want to have a plan that makes it easier for you to find people in the marketplace, and that is becoming more and more difficult. So you can use that ongoing evaluation to also be thinking about some of those things.
Great.
Yeah, and I would just add to that, just reiterating what we said earlier about making sure you're talking to your advisors, organizing early. And to me, it comes down to what were your pain points last year? If you think back to what caused you pain, what caused you delays last year, address those now. Because pain is a signal that there's something wrong. You need to fix it.
Very good, Dr. Brewer. Thank you very much on that one. So we do have one last question that came from the audience. It's sort of very similar to maybe the person that submitted earlier, but under an IRS audit from a plan year when a former advisor was on the plan, are they obligated to participate since they were part of the plan for the year it was being audited? So, I would say, I think, again, if you're talking about a retirement plan advisor to your plan, again, I don't know the legal responsibility there, to be honest. I think it'd have to be, sort of under the contract, but it depends on what the IRS and the DOL is looking at, right? Because if they're looking at, if they're finding some issues around, late contributions, that has nothing to do with the financial advisor, right? If there's issues around vesting or not properly allocating employer contributions, that has nothing to do with the advisor. That's really on the record keeper and the plan sponsor. If there's something around an investment change that was, recommended or should have taken place, or, something about, say, for example, the fees that were taken out of the account or out of the plan that were charged by the advisor, yes, 100%. So I think it truly depends on what questions are being asked. If there is a question being asked about, something that specifically pertained to the advisor and that firm's role in the retirement plan, and the questions around the audit, then yes, they should. Legally, I don't know the answer, but I would think that that's going to be something that they're going to have to respond to. And I would certainly, if you're having some troubles there, I would get an ERISA, get your ERISA attorney involved to maybe ask that question. If you need some recommendation there, we got a great one here locally in Towson that we work with a whole heck of a lot. We'd be happy to give you, contact information for. So.
Yeah, Greg, I think you're exactly right. That's, if you get into that situation, get that ERISA attorney involved. And I'll also say, I'm like you, I'm not an attorney, but to me, there's a legal answer, but then there's just a business answer. Right. If I'm that old advisor, I'm probably going to help out because I want a reputation in the marketplace as being a problem solver. Those of us here on this, although this webcast applies to anybody across the country, we're resident in the Baltimore metropolitan area, so we call it Smaltimore for a reason. You don't want to get a reputation as being uncooperative in the marketplace.
Yeah, that's certainly not going to serve you well in as you say, Smaltimore. And not being from here, you learn that really quickly.
That's right.
That's exactly what it is. So. All right, well, guys, I really appreciate it. Thanks to Ryan and Mike for joining today. We've done some other webinars in the past with Clearview, but the first one with Mike and Ryan, really appreciate you coming on board as a client of both Clearview and Greenspring, and taking time out of your day to help our clients and others around what your processes are. And how you've navigated through some of these things. So, and then thanks to all who joined today, especially those who submitted questions prior to the webinar and during the webinar. Yep. And hopefully you learned something today about, maybe a few strategies that, you can use going forward as you think about the audit for plan year 2020 this upcoming summer. Obviously, if you have any additional questions, feel free to reach out to, whoever sent the invitation to you. And they can put you in touch with the right person, whether it's myself, Ryan, or Mike, or someone from our teams to be able to help answer your questions. We did record this, obviously, so we will be sending it out. So you can, you can listen to a second version of employee plan benefit audit talk, which is hard to say. After going through it for 52 minutes, apparently. So anyway, everybody have a great afternoon. Please be safe and healthy out there.
Thanks, everybody.
Thank you.
Bye.